Welcome back to the Daily Journal. So we are reviewing the 6 a.m. reversal from yesterday, that being Wednesday, on NASDAQ. In fact, it was a trade that one of the community members who is going through my free course on my model, he took this yesterday. So let's review it. So starting off on the weekly here, we've clearly been trending upwards. We've had a pullback into this massive gap, right? So dropping down to the 4 hour. You can see our price has just been, expanding low, retrace, expanding, and now it's been consolidating. So it's this candle coming up that we are anticipating a reversal. If we take out the lows, which we most probably are going to, I mean, we've just closed this candle bearish, and there's no wick on this candle, so that's a form of an inefficiency. So it would be a high time frame inefficiency. Of course, we've also bounced at this 4 hour order block. So dropping down to the 15 minutes. Right, so with the 4 hour, we are anticipating here a 4 hour reversal of this next candle. So looking at the 15 minutes, we've expanded lower and we've retraced, but we've consolidated, and now we're dropping. It's a one-sided move directly into this fair value gap. So we've also swept all the sell side liquidity. And now going into the opening of this trade, the opening of this next candle, we can drop down, and what do we see? Well, equal highs. In addition to that, I can see swing failures and a lot of inefficiency. So those are the two things I need to look for and confirm to validate the accumulation side of a market maker bar model. So we've swept the high time frame. Well, we've swept high time frame liquidity. If we drop lower, this is also high time frame liquidity. So there's a start. It's the opening of that 6 a.m. candle. Now we are anticipating a reversal. Now, personally, I would look to rather trade the continuation once we get the reversal, simply because anticipating a reversal candle for your high time frame is always going to be risky, because not only are you anticipating a reversal of your high time frame, but also the middle time frame. Let me just clean this up for a bit. So to look for a reversal on the 1 minute, to potentially have a reversal on the 15 as well as the 4 is exceptionally risky. So at the very least, you should just wait to trade the continuation. So there we go. Off the bat, we get the wick being potentially formed for the 4 hour candle with a change in state of delivery. So at this point, you could take the trade here, but it's exceptionally risky. I mean, look at this. There's by the time this next 15-minute candle closes, you're going to have this massive gap that you're trading into. So it's always better just to wait for a continuation. So we'll need to see price trade into an inefficiency and or liquidity, and then have another change in the state of delivery, or rather to form an order block, to confirm that price is in fact going to continue. And here's the thing, is that once you have price trending in the opposite direction to which it came, once you've confirmed your, clear drawn liquidity being equal or relatively equal highs, then confirming the swing failures and inefficiencies on the first side of the retracements. That's the retracement. That's the market makers accumulating longs. So you can see that we have swept these swing lows. So now we can anticipate potentially this forming into an order block. That would then become the protected low, and this would be a continuation. There it is. So now you can put your stop loss at that order block, your low over there, stop loss at that low, which is now a protected low. And so there's a much higher probability that, in fact, we wouldn't have even gotten into that trade. Well, I think we did actually. Yeah, we did. But just a FYI, typically it will just have it just above. You never know. Its correlated pair could take it that level out, and this could continue without you. Okay, so at this point we're in this trade, and something I want to point out is that I used to only trade reversals. I didn't know how to trade continuations. This is a bit of a different story because it hasn't really expanded yet. When price expanded, I'd missed the entry for the reversal. I would often just not get involved because the risk reward wasn't worth it. I mean, let's just say I didn't get in here because I was looking for more confirmation. Getting involved here, it just for me I was like, oh, it's not worth it, etc., etc. Until I learned how to trade continuation. And my point I'm trying to make is, if we are going for the same drawn liquidity, this would be a 6.4R. This is a 7.1. So you actually have a higher risk reward, although the probability is greater. So quite frankly, it's a no-brainer to get involved in continuations. That isn't always the case, but what I will say, at least for the next entry after the reversal, but what I will say is that once you understand where price is going, where you enter is the least important part. Where price is going and where you're invalidated are the two most important things. So at this point, you're either in this trade or you're waiting to get on side. And so what you could do then is look for price to come back into one of two things, right? You have to look for a sweep liquidity and or an inefficiency. So we can use basically this entire little range there. So once price drops into that, it's always better just to use the top. You don't have to be perfect. You want to make sure that price is going to continue higher. Right, so price is actually traded into this inefficiency. Look at that volume imbalance, which is a much greater drawn liquidity than a normal fair value gap. So traded straight into that. And now what you can use is that for the order block. And of course, you've had expansion, consolidation, expansion met with expansion as a reversal. So there we go. So what you can do now is get inside. That's your protected low. And you can just market order in. And there we go. Still just over 4R, which is still brilliant. And this is a balanced price range. So if you wanted to, you could even, let's just say you were already in this trade. You could drop this down to that balanced price range. And there we go. You got a 7-on trade with higher probability. So there we go. Jumps in and off you go. So at that point, you're coming up to 0.5 of this range. And so you want to look for trades, of course, in discounts like we have here, which are always going to be a higher probability if you're looking for longs. Yeah, let's see how the rest of this trade plays out. You can see it consolidated for a while, then expanded, and eventually it hit the drawn liquidity. Let's see, that was at 6 all the way to about 8.30. So in the end, you've got your market maker model played out. Stunning. As I mentioned, I would have much preferred taking the continuation entry here, simply because it's a reverse on the 4-hour as well as the 15 minutes. At the very least, in your lower time frame, trade the continuation. Reversal on a reversal on a reversal is just super risky. There's absolutely no guarantee that price is going to just, reverse like this. And so you look for a high probability. And the thing is that, again, like I mentioned, once you know where price is going, just look to get on side, find a protected low and get involved. And clearly here, if you had just waited, say you missed this, you got here late, you had 30 minutes to get to, until price, reversed, you had 30 minutes to look to get inside. And even here, you could have, got inside somewhere here, although you're starting to get into premium of this range. So there it is. Really, shout out to Nick in the community for taking this trade. Absolute banger. Cool, guys. We'll see you in the next one. Cheers.